Earlier this week, both Uber and Lyft stocks combined lost billions of dollars in market valuation. This was in part because Google's Waymo, their driverless division, announced that they're going to Miami. What's this even mean for Uber? Why would the news of autonomous vehicles expanding hurt Uber stock? So we're going to cover all this and more. Thoughts around Uber's current valuation along with their fundamentals. If you enjoy educational investment content, you're watching Unrivaled Investing. So let's dive right into understanding what is going on with Uber's. Let's start with their results first. Looking at their third quarter results, you see the active users on their platform up around 13%. This is spread across both delivery and mobility. So if you want to get groceries, if you want some food from a restaurant, or you want to get from point A to point B, that's around 160 million people using it in the most recent quarter, up 13% year over year. And of those people using the platform, of those active consumers, there was a 4% increase in usage. So more users increasingly leveraging the Uber platform. That suggests a very healthy platform. And you can see the number of trips on the platform to 2.9 billion during the quarter. That's an incredible figure, just hearing that there's that many trips. And you can see the amount of money, that amount of gross bookings growing across this platform, $41 billion, up 20% year over year. And their profitability is surging. EBITDA up 55% year over year. Management is getting serious about showing real profit, real free cash flow, and it's broad-based. It's from the mobility segment where you can see strong growth in bookings along with a surge in profit margins, profitability, as well as their delivery segment that's not growing as quickly, but you are seeing this positive trend in terms of margins and revenue growth. And so this is, these are broad-based favorable developments. Now you might be wondering what's causing the margins to go higher other than cost discipline. And I think it's partly from looking at different ways, different creative ways to get higher margin revenue streams across the platform. Now, management does talk about looking at this particular markets that they're in and looking at infilling in certain markets, maybe where, it's less dense, and that, obviously if you're in a less dense market that you're looking to fill in, you might be able to create, better spreads for your business. So that's one aspect. They're also growing their advertising business. That's growing nearly 80%. Think about the prime placement though, that this advertising business can have. Because if you start getting these loyal customers, tens of millions of loyal customers, they talk about 160 million actively using the platform in the month during the third quarter, pulling up their smartphone, pulling up the Uber app to say, you know what, I'm not feeling like cooking today. I just want to get delivery and I'm not sure what I want quite yet. That is just a beautiful position from an advertising perspective, because those restaurants, they know you're interested. They know that they're located near you potentially. And that's a beautiful, potentially high return on investment for them then and there, and that can influence your decision. So you can see why their advertising business is growing quite significantly and very high margin type of business. We know from looking at the large, advertising businesses like something like a Meta, you're talking about 40% type profit margins, even higher. Then they're also growing their membership business. That's around 25 million members. That's also up around 70%. So you have the advertising 80% roughly, members up 70% roughly. And it's because folks are saying, I use this so often that I want to get these perks like zero delivery fees on the food and groceries. I want to get some benefits for when I am riding, maybe a 10% off eligible deliveries or 6% on credits for eligible rides. So they're looking at this saying, yeah, for $10 a month, this is a no-brainer for me to sign up. And that's 25 million people signing up for Uber One. And then they're also talking about growing more premium services like Uber Black, and that's causing, the margins to help expand as well. So looking at Uber, looking at what's going on, not only do they have these growth trajectories and growth initiatives, but they're leaning into the future as well with partnerships with Waymo in markets like Austin and Atlanta, which they just announced literally, a couple of months ago. This was September 2024, announcing, yeah, we're partnering with Waymo to launch in Austin and Atlanta. So, don't worry about autonomous vehicles. We will partner with the best companies out there, the ones that are, actively taking market share. And we will bring our customer base that's looking for that riding experience. We will bring it to those autonomous vehicles. So that's, the autonomous ride options, which right now is predominantly Waymo. we'll talk about Tesla in just a second. But then earlier this week, you see this announcement from Waymo saying, oh yeah, we're coming to Miami, but by the way, meet our newest fleet partner, Move. I believe Move is a private company. And so this does create the uncertainty that you can have these autonomous vehicles try to disrupt the current, mobility market and try to say, hey, maybe we don't need to go with Uber. Maybe we can explore other partners that would be happy with maybe lower rates. Maybe this creates some sort of bargaining chip in some of the other markets that we're in, like they're talking about going to Atlanta and Austin. So this does create the uncertainty about Uber's long-term trajectory of, hey, do you have more competition? Because Waymo, they have their Waymo One app, where consumers are going to say, hey, why not just pull that up directly? Why not use that? And hey, don't you have this new fleet partner that's going to be managing their Waymo vehicles? Not even mentioning Uber, and Miami could be a big market. So this is what drove, Uber and Lyft stock to drop. So what are my thoughts around this? What are my thoughts around Uber's current valuation? First of all, as always, this is not financial advice. And also recently, Matthew, a premium member of the Unrivaled Investing community, shared the following. This is a direct quote. Netflix, Spotify, and Unrivaled are the only subscriptions I'll never cancel. Seriously, this is an incredible value. You've helped me and my wife comfortably take time away from work to travel and had the financial confidence to start a business of my own. Even without any income for 2 years, my portfolio is still up. That's a direct quote. So if you're looking for compelling ideas, come check out Unrivaled Investing. Also, the premium member does have exclusive access to our Discord, where I'm interactive and talking with the members on a regular basis. So I think it's super important to reflect on aggregation theory. This is something Ben Thompson has talked about repeatedly. And the aggregation theory, if you're not familiar, it's that in a digital network, most of the value flows to the aggregator. So who owns the end consumer, which leverages the accessibility and zero marginal cost of serving incremental customers and capturing the lion's share of value while exerting significant power over suppliers. Okay, so what does that sort of mean? That means the player, when you're looking at Uber, Waymo, Tesla, Lyft, whoever has the most customers on their platform, and recognizing that signing up another 10 million customers, that doesn't really cost you much in terms of, from an incremental cost perspective. Yes, there's marketing tied to that. And yes, there's server costs. But broadly, it's much closer to zero than it is like, oh, each new customer is going to require $10 in monthly servicing. That's not how that business model works. And so when you own the end demand, just like we showed a minute ago, talking about how, hey, all of a sudden this advertising business, unexpected but very lucrative, is growing quite quickly and is an important contributor to their sort of future trajectory. It's whoever owns that consumer relationship that's going to create most of the value over time. And you see it across a lot of different industries that are heavily reliant on the digital networks. For example, think about Netflix. Netflix has become a true disruptor because, you used to say, well, wait a second, who owns the supply? Netflix didn't even have any of the supply, but they owned the demand. And they recognized, hey, in order for us to really feel comfortable over time, we're going to have to create our own supply. So you're seeing that sort of dynamic here where they're saying, with Uber, they own the demand and, across 160 million monthly active users. But then you see the hyper growth with Waymo, and it's causing people to get nervous because in just a few months, Waymo has gone from effectively zero a couple of years ago to 150,000 paid rides per week. And I think that number is now even higher. And that's just across, like San Francisco, Phoenix, and Los Angeles. And now most recently, they just opened it up to, I think, all of a part of Los Angeles. I don't think it's truly all of Los Angeles, or maybe it's LA County and anywho, so they opened it up to a sizable part of Los Angeles, not South Bay. And so looking at it, thinking about this growth, and, that is a red flag to think about. One, Waymo is growing exponentially. So whenever you see some sort of market share growth from a competitor, sort of saying, hey, you have more and more users going to the app, circumventing Uber, saying, you know what, maybe I don't even need to use Uber. Maybe I could just use Waymo One, go directly to the autonomous vehicle. So that is sort of a red flag to be mindful of. The question is, how much of that is actual convenience and how much of that is, wow, I'm blown away that I can drive and ride in a car where there's no one sitting in the front seat. And I think that is sort of a magical experience that a lot of people are going, wow, life-changing. It's exciting to be in this new era. Another aspect is, could you start seeing significantly lower fares because of Waymo 1? I don't think you're starting to see that yet. And correct me if you're one of those customers in Phoenix where you're like, oh, this has completely crushed the Phoenix market and fares are now, pennies on the dollar versus where they used to be. But you haven't really seen that significant change in value proposition where you'd say, oh, well, this one costs $1 or this fare costs $4 and the Uber costs, $25. Therefore, there's just going to be this surging interest in Waymo. So I think there is that aspect. I think another challenge that Waymo's going to have, so right now, I don't think you're quite seeing the pricing enough to fully disrupt the markets. But another aspect is, and this was a comment that Bill Gurley had talked about on a separate podcast, I think BG2 or something like that, where, he was making the point, look, they're in a tricky position, Waymo, in terms of if they want to win this market, do they build the amount of cars to the peak demand or do they build it to the average demand? Because either way, you're going to have unsatisfied customers. If you're building it to the average, then you have customers tuning into the Waymo app and saying, oh, it's going to take a super long time for me to get a car. And if you're building it to peak, then you're going to have a lot of cars just sort of idling, and then your return on investment is going to be quite low. So you have those different dynamics. Now, one might say, well, wait a second, this is still majority owned by Google, and they have super thick pockets, super deep pockets, so they could take their free cash flow to sort of support Waymo if they wanted to take the market share. So that is, sort of a concern for Uber to think about. My view, going back to that aggregation theory, is that there's going to be more than one autonomous vehicle player out there. And we've already seen, Tesla making progress with their full self-driving initiatives. And, Tesla is going to say, hey, we're going to have our own app where you can go to it. I think in order to win, you're going to need an aggregator like Uber that addresses, oh, I don't own a Tesla and I still want to go on an autonomous vehicle. So, how are you going to find those customers? And maybe Waymo hasn't fully, built out the market yet in Los Angeles. And then you're going to say, well, I want it ride right now. Yes, I want what's cheap. So it's going to be who's going to bring the supply. And I think you're going to have multiple autonomous players. And then who's going to bring the demand? And right now that's Uber. So I still think that they're in a solid position. But I think this does create incremental uncertainty for the business long term that's important to be mindful of, that to think about, as you consider the valuation. So I don't think with this incremental evolving landscape, you want to assume a super premium multiple, let's say 5 to 10 years out. I think it's important to have more of a discounted approach just to be more conservative. At least that's how I'm thinking about it. And so looking at Uber, I don't think it's crazy expensive, on a free cash flow basis. Now there's a lot of sort of non-earnings components to free cash flow, like adding back stock-based compensation and their insurance reserves that weren't actually used, and they're building up their insurance reserves. So looking at that, it only trades around 20 times free cash flow, which some folks might say like, wait a second, isn't that like deeply compelling, 20 times free cash flow? And I could make the argument like, hey, if you're at 20 times free cash flow and that free cash flow can indeed go back to you as a shareholder, they're not yet doing it in a meaningful way. The share count's still going up. But if you start seeing that spigot, and they've talked about, share buybacks and that sort of stuff, but if you start seeing that in a meaningful way, then, I think that's another sort of favorable driver for Uber stock. But being at 20 times free cash flow, if you're able to compound if the free cash flow is able to stay at that lofty level, which implies around $6-7 billion in free cash flow, their earnings is much lower because of that stock-based compensation and insurance reserve releases. But that would make it appear very reasonable valued. And you'd say, hey, 20 times, if you're still 20 times 5 years from now, then it's all that growth between now and then. And you have a business growing at roughly 20%, a little bit under if you factor in on a share per share basis. So I look at this, and overall, I think Uber, I think I'm biased to the upside when I think about Uber in terms of where it can go. I would think it has probably more upside than downside at this point. Now, keep in mind, this is a hypothetical valuation framework. Of course, the stock price can go way higher, way lower. I can be wrong, but I'm trying to apply some sort of reasonable conservative framework. Right now, operating margins around 9%. I'm assuming somewhere between 10 and 20%. Right now, they're growing their business around 20%. I'm assuming they continue to grow at a teens rate. If there's a recession, that will not happen. And then I think the stock would probably have more downside than what I'm penciling out here. I'm assuming around 15 to 25 times earnings multiple. So staying around, let's say, a 20 times multiple. And so that does get in a upside scenario, 100, 200% upside type of dynamic. So I look at this and I think, can it keep compounding in the years ahead? So far, I haven't seen enough to say Uber's being disrupted. So far, I'm looking at this, and if I had to bet on it, I haven't, but if I had to, I would say I would bet favorably versus short it personally. If I had to make a bet on it, personally, thinking about my own checklist, I'd rather find things where I feel a little bit more comfortable in terms of either the alignment. I personally like founder-led stories. I'm a sucker for founder-led stories. If you have a founder that's like, oh yeah, this is my baby, and it's my dream to make this 10x bigger, that's the type of thing that gets me excited. So when I see, like a family, and later this week, I'll be sharing notes with my subscriber base, because I'm having a call with the CEO and CFO of a company that I'm investing in. So it's like I'm looking for those types of founder situations where the CEO, his family, started it and they own 40% of the company, and it trades at 13 times free cash flow. That's the type of situation where it's a little bit easier for me. Whereas here, the story with the founder, Uber, that's obviously no longer the case. Travis is no longer with the company. You can Google what happened to him years ago. And so and also the sense of inevitability with Uber. I'd say there's a little too much of this, like, if Waymo really wanted to make this unpleasant for Uber, I think they could. If Waymo is like, you know what, we're going to win this. What we're going to do is we're going to start whatever the Uber rate is, we're going to offer 10. And that's how we're going to make the Waymo One app just dominant, is because people are going to say, hey, I would rather wait a little bit because, it's just cheaper, and I'm going to be getting, my groceries, or, get my mobility. They haven't rolled out the grocery yet, but you could see that's clearly like probably where they're going in the future is, hey, just load the groceries to a car, and then you have someone in the grocery stores. Anywho, it's an evolving dynamic. So I haven't pulled the trigger on Uber. I would rather, from a checklist perspective, I would rather have something where it's a little bit more obvious to me, and you also have that clearer alignment. And when I see the share count still going up despite generating significant free cash flow, that's like, that's a founder-led business. You're less likely to see that dynamic, in my opinion. Anywho, I hope this video talking about Uber, sharing my thoughts about the potential disruption from Waymo, has been helpful for you. And I'd love to hear your take in the comments below, because there's a lot of different pieces here. And so if you feel like I've missed something, I'd definitely love to read about it. Thanks so much for tuning into Unrivaled Investing.